Hey traders, I want to take you through a 4-hour swing strategy. It's a strategy that allows you to find the best support and resistance levels to buy and sell at. That allows you to take maximum profit based on how the market likes to move from 4-hour point to 4-hour point. So let's take a quick look at how we find the 4-hour swing levels of support and resistance to trade off of, and then we'll show you some examples of some trades. All right. All right, so let's take a look at a 4-hour chart here. This is a 4-hour chart of the MYM, micro YM Dow 30 futures contract. And as you can see in the last, last several weeks, May and June, we've been on a pretty good uptrend. And some pullbacks here, but overall, we've been on the upswing. So we, for the most part, are looking to buy support and sell resistance. So as price comes down to a 4-hour level, we want to take the bounce off that level and ride it up to the next 4-hour level. That's basically the strategy. All right, so how do we find these 4-hour levels? Well, it's pretty simple. You just start examining the candles, and you look for candles that have swing high points, meaning that the candles to the left and right have a lower highs. Okay, so for example, here's one. Why is this one? Because the candle to the left and the candle to the right had lower highs. Same with this candle, right? This candle to the left had a lower high and to the right had a lower high. That makes this a swing high candle, okay? So same would be true with the swing lows. All right, the opposite situation. This candle is a swing low because the candle to the right had a higher low and the candle to the left had a higher low. Okay, very, very simple. If you stop and think about it, just examine where the wicks are very carefully and you'll be able to see them easily. Same with this one. This is a swing low 4-hour candle because the swing low to the left and to the right are both higher, and the opposite is true up here. Swing high candle because the candle to the left and to the right are lower. Okay, so mark all these up, and then we'll use these as price returns back to these levels. We'll use these levels to take trades off of. Okay, and why are these important? Well, it's a swing point on a 4-hour chart because a lot of volume came into this level and reversed the direction of the trade. Okay, and that is done by institutional investors and institutional traders, not retail traders. So we want to be trading with the institutions, not against them. So let's do what they do and join forces with them as they come back to these levels. Price comes back to these levels. There's going to be good volatility, good volume in those areas because that's where institutional traders are going to be defending their positions, and retail traders who got caught with their flat-footed are going to be trying to get out with the smallest loss as possible. Okay, so now let's take a quick look at some examples here. Let's take a look at Thursday morning. We usually log in around 30-second chart. I usually log in around 7:30, 7:45 in the morning. So on this past Thursday morning, log in just to find that price has come down to a 4-hour swing here and bounced off of it. Okay, it was 7:45. So we're going to look for a MACD cross. For the MACD cross, it's probably one of the most important parts of the whole strategy is to wait for a MACD fast cross on the 30-second chart, and then we wait for what I call a trigger. So that'd be in the form of a resolved pullback, and I'll show you what that is, a hammer or an engulfing candle. Okay, so we see here that price came down to this 4-hour swing low, which just happens to sit right on top of the big round 52,000, which it's no accident they're together. That's a psychological support level, right? So it formed a 4-hour swing low at that level. Okay, price comes down to it and puts in a bounce with a MACD fast cross is noted right down here. MACD fast cross, and then we're just looking for what I call a trigger. Okay, so it's going to be an engulfing candle, which is this. You can see this is an engulfing candle that is marked by one of our indicators because the high is higher than the high of the candle to the left and the lower is lower to the candle to the left. Okay, so that's an engulfing candle right there. That would be a trigger. We could also do it with a resolved pullback, which would be a little bit higher up, like right around here, or a hammer, which we could do like this hammer right here. But anyway, let's use the very first signal that we get after we get the fast cross in the MACD after that support bounce. And we'll use this one right here as our trigger. And we'll we'll look at, lately I'm looking at a lot at this 30 micro level because it divides by 5 and by 2 fairly easily. And we want to divide by 5 because I'm trading 5 accounts and I want to do it in 2 lots. So I need something that divides by 5 and by 2. This also does, but it's 125 points, a little bit too big. This also does, but it might be a little bit tight at 62. 83 gives me a lot of breathing room, and I don't have to take the full 83 point stop. I can take a 40 or 50 point stop, but max would be 83 if I really need it. I've got it. And again, that keeps me under my 5.5% per account. Each account that I have has $4,500 drawdown. $250 out of $4,500 is only about 5.5%. So it's a very, very, very conservative way of trading. It helps me stay in for the long haul by doing it that way. Okay. So anyway, like I said, we're going to go ahead and grab this long right here with a 30 contracts. So we're going to look for 15 ticks for the first lot. We're going to get out 15 ticks right there. And then we'll move the stop up to 15 below entry right here. So you know, if it wants to oscillate around a little bit, that's fine. It's not going to stop me out here. Even if it did, we just take the next one, like this one right here, which definitely would not stop me out. So this is a way of letting the trade breathe around the entry level. So we can oscillate and go back and forth a little bit until we're ready to, you know, head up. Okay, so anyway, we get in here, we take the first lot off at 15, move the stop 15 below, it doesn't hit the stop, it heads up. Now, where is the target? Let's go back to here for a second. And we're going to find that target up here, right? Because we've got this swing high and this swing low, and they're right next to each other. That's no accident. That's no accident at all. Okay, you find that these levels will often create double levels, all right? 2 and 1. Like, for example, this one and this one right here. So here's another double. Okay, so that's going to be a very strong resistance because there's 2 of them. It's a double resistance. Okay, so we're going to put our target about 25 points under the lower one. 382, 372, 367 should be the target. I just put a target right here, 367. All right, so we know what we're looking for. We can set that target when we get into the trade. Okay, so like I said, we got into the trade down here. Okay, it oscillated around a little bit. Even if we would have been stopped out, we could get right back in on this hammer right here. And on this one, 15 above, it never really came back down. So let's just say we did get stopped out on this one. We didn't get in exactly where we should have. Maybe we got a little bit early, who knows. But we're going 15 ticks and 15 ticks with a 30 lot, so 15 contracts off the first target, and we're holding another 15. Okay, so now we are moving up, up, up. We're going to use these EMAs that we clear as support levels. Okay, we've got this EMA holding, all these EMAs holding price up. This EMA is holding price up, and then our target is up here, right? We set this as our target at 367. Remember. And so a couple seconds, a minute into the open, target gets hit. We're done for the day. All right. It's not. We started at 7:30. It is now 9:30. We trade for 2 hours, and we've made about 315 points. Okay. Now on the Dow, just so you know, every point's worth 50 cents. So 315 points is 155, about 155, $157, okay, per contract. All right, so we have 15 contracts left over. We made $157 per contract times 15 contracts. That's $2,355 on the second lot, and about, I don't know, it's about $25 on the first lot. So it's pretty good for a morning's work. It's about $1,200 an hour we're making. Can't really beat that for, you know, beats working at Walmart. And that's basically the way you want to look at these things. Let's look at another example from Wednesday. I think Wednesday was a little tougher to do. You had to really be on top of your game to do to win on Wednesday, but it was totally doable. It just looks a little bit different. All right. So on Wednesday, we also want to make sure we take a quick look on Wednesday where those levels were on Wednesday. Here's Wednesday. Wednesday was Fed day, so it was kind of a weird day. But this is the this is where we kind of came in on Wednesday right here. So this, like I said before, this swing low was not yet a swing low because you can't mark a swing low until you know where the candle is going to close. The next candle is going to close. If the next candle closed lower, then that wouldn't be a swing low. But we know now that it became a swing low, but at the time we didn't know. So we're just going to take that one off for right now, move it down a little bit. Well, let's not move it down because I don't want to forget about it. But basically, the swing low we were looking at was this one at 52,381. Okay. All right. So we log in 7:30, 7:45 on Wednesday. On Fed day. Was Fed day Tuesday or Wednesday? Let's see. Confused myself for a second. Wednesday. Okay, we just looked at Thursday. Now we're looking at Wednesday. Okay, so let's move up to Wednesday. Sorry, guys. All right. What's going on Wednesday morning? All right. Here we go. Okay. Like I said, this swing low, we didn't know it was going to be one until the 10 o'clock hour over here. So, but we did have this, this was a swing low here of that 4-hour block. So, anyway, we don't have to look at that right now, though. All I can tell you is that price was hovering above this 4-hour swing level all morning long, right? It kind of, when we logged in around 7:30, 8 o'clock, we could see that it was kind of, it was in a consolidation range, basically. Basically, price was consolidated in a range, all right? And it was just going back and forth in this range, okay? So it never really got down there, but it was still holding it up, right? Technically, you're pretty close to it relative to where the next one up is. So if you're trading, okay, low is here, and here is the swing point, and here are the lows of your consolidation range. Compare that. Let me darken that a little bit so you can get a real sense of it. Just, try to use your mind's eye to say, okay, are we sitting on support? And if we are, where's the next, make this green because that is support. Anytime you're above a level, you want it to be green to remind you that that is support. Okay. So from the grand scheme of things, if you're looking at this, you can see that you want to always be buying near support. You don't want to sell into support. You want to buy from support. So you have to gauge and say, okay, I'm in a trading range, but is that trading range closer to support or resistance? And obviously it's closer to support. So if you get some kind of buy signal at the open, at the New York Open, even though you didn't actually touch the level, okay, you're consolidated close above the level. So if you get a buy signal at the open, then you want to buy, not sell. You want to be oriented towards buying, and then you want to be oriented towards this is your target, okay? I hope that makes sense. So in other words, it doesn't have to bounce directly off the level. If it consolidates above the level and at the open it starts moving up, then you want to find your MACD cross at the open, and then your pullback, which resolves, or a hammer or a engulfing candle, okay? So in this case, we never touched support, but we consolidated above support. The open comes, we get to MACD fast cross right here. Okay, I'm going to mark that so you can see it clear as day. All right, there it is right there. Now, as soon as you have that, you want a pullback that resolves, a hammer, or an engulfing candle. What do we get here? We got a pullback that resolved. What do I mean by a pullback that resolved? Okay, a pullback that resolved means that price went up, it pulled back, and it continued. Okay, so we can see that continuation pattern by the fact that it was bouncing off our EMAs here. This is our favorite or strong EMAs, right? The 1 minute 100, the 1 minute 200. All right, it put in this perfect reversal doji right here. You can see like that's a 30-second candle, but man, is that a good indicator of what's happening? It's reversing, it's pivoting right off that level, right? It goes up strongly, it pulls back, and then it resolves with another green candle. Okay, so that's our clue to get in right there. That's our cue to get in. Now, because it's the first, first 5 minutes, I'm going to give it more room. I'm still going to keep about an 83% or 83 point stop. So that puts the stop down here, right around the bottom here of this trading range. All right. Actually, that's the 4-hour swing part. The trading range was here, so it gives us plenty of room. That's about 80 points right there. Yeah, that's about 84. That's what I need. I need 83 points, 83.33. So I've got it. It's my standard stop of 83 points, right? You don't have to change things around all the time. You can just keep them pretty much the same. So I'm getting in here at this resolution, or this pullback and resolution, right? I'm taking my first targets off 15 points right there. And then I'm moving my stop up to 15 under my entry. 49 right there. Okay, boom. Off to the races. Off to the races and headed what? For the target. The next 4-hour swing point, right? And there it is. There it is right there. See how it hits it perfectly? Pulls back. We can be 10, 20 points under that if we want, just to make sure that we're not going to miss out on it. You can do it like right up there. All right, so that was what? 163 points. And that would be $80 a point, $80 a contract, right? That's 50 cents a point per contract. So that's $81 per contract. 15 contracts. You took half off already. Sorry, 80 bucks contract times 15 contracts. That's $1,200. Okay, that's what we're gonna make. We're gonna make 1,200 bucks off that trade. All right, and that's keeping risk pretty low. All right, it's not very likely in a case like this that you're suddenly going to come down and hit this stop down here. I mean, it could happen, right? It could definitely happen. But we have, which is a rules-based strategy. The rules say you have to wait for the MACD cross. You have to be buying support, okay? And we determine that we're at support down here because we're at above this 4-hour swing point, which you've been holding all morning, right? Been holding all morning. Price launches up here, pulls back, puts in a little doji and resolves. That's what we need after the fast cross the MACD. Above the support, we're a buyer. We'll wait for a pullback and a resolution or a hammer or a fast cross. You can also sometimes look at this type of candle as a buy signal. It's a reverse inverse hammer. It's a green shooting star. It's a very bullish sign. Okay, we see that at support. The next candle up from support, quite often we see that, very often. So that's a good one too. And yeah, that's it. If you're at the open, you can maybe take a little bit wider stops and targets, like maybe 20 points, 25 points. You can program that on your ATM. If you can have access to an ATM, that's a good thing to do. And then you target, like I said, the next 4-hour swing point above. Now, this one actually ended up going well above that, but that's okay. You're happy with your 4-hour swing to 4-hour swing, okay? So that's an example from Wednesday. I know that might sound a little bit involved, but if I were you, I'd take a screenshot of this, and this tells you everything you need to know. If you are trading the way I'm trading with a $1,250 stop, that's 30 micros with an 83-point stop. That's $1,250. I'm doing that because I'm trading 5 accounts totaling about $22,500 in drawdown. So 1,250 is about 5%. So that's why I'm using that number. But use whatever number is comfortable for you. If you need a risk chart, use this one. This is mine, but you're happy to take a screenshot of that. Use that. I have for MNQ as well here. Okay. All right, that's really it for now. I'm going to leave it right there, and it's a strategy that really works. It really, really does. You almost call it a cheat code. It really works well, and it allows you to take some pretty good profits pretty easily. Okay, that's it for now.